Hey everyone, ready to dive into the world of trading. But maybe feeling like, whoa, hold on a sec. I don't want to just jump into the shark tank?
Yeah, I get that. It's smart to be cautious.
So that's what we're doing today. We're going to equip you with the knowledge you need to navigate the market and hopefully avoid some of those painful beginner mistakes.
Right. It's all about learning from those who've been there, done that.
Exactly. Which is why we're taking a deep dive into 10 common trading mistakes based on the insights of Yul Zur. He's an experienced trader and, get this, a mental consultant.
That's a really interesting combo. Most trading advice focuses on like the technical stuff, charts, indicators, all that.
Right.
But Zur digs into the psychology of trading,
Yeah.
like how our emotions can actually sabotage our success in the market.
Okay, I'm already intrigued. So, imagine this.
Yep.
You're scrolling through your trading platform and you see this stock. It's been climbing steadily. It looks like a winner. You're thinking jackpot time to get in on the action. But pump the brakes for a sec because Zur actually tells a story about a trader who did exactly that. Jumped headfirst into a hot stock tip without doing any research.
Oh no, I can already see where this is going.
Yeah, it turns out the company was facing a massive lawsuit that wasn't public knowledge yet. The stock tanked, and that trader, well, let's just say they learned a very expensive lesson.
Ouch. That's a perfect example of why preparation is absolutely key. You wouldn't jump out of a plane without a parachute, would you?
Nope, definitely not.
Trading's the same way. You got to know what you're getting into before you risk your hard-earned money. Zur actually uses this great quote. The market's like a food chain. The big fish eat the small fish. It's from another trader, Robert Deal.
Okay, love that quote.
Mm.
So how do we avoid becoming fish food? Where do we even begin with this whole preparation thing?
Well, Zur recommends a few things. First, immerse yourself in the world of trading. Read books written by experienced traders, follow reputable financial news sources, listen to podcasts.
Like this one, of course.
Exactly. The more you expose yourself to different perspectives and strategies, the better.
Gotcha. It's like laying the groundwork before you start building.
And just like any good builder, you need the right tools. That means getting comfortable with charting software, understanding those technical indicators,
Yeah.
learning how to read those market signals.
So studying, learning the lingo, but trading isn't just about crunching numbers, is it? It's also about how we react to those numbers.
Yeah,
And that brings us to our second mistake, letting our emotions call the shots.
absolutely. Zur makes this really interesting point about how money is often tied to our sense of security and even self-worth.
Right.
So when our investments are doing well, we feel amazing, almost invincible.
You're on top of the world.
But then when those numbers dip even a little, we can spiral into fear and panic.
Oh, yeah, been there, done that. Not fun.
And that's when we tend to make those impulsive decisions that can really hurt our portfolios.
Okay, so how do we stop those emotions from hijacking our trading strategy? Because let's be real, we're all human. We're going to feel those highs and lows.
Of course. The key is to become aware of those emotional triggers and then develop strategies to manage them. One of the things Zur suggests is to start small. Instead of going all in with a huge investment that's going to send your emotions on a roller coaster, start with an amount you're comfortable losing.
I like that dip your toes in the water first.
Exactly. That way you can get a feel for the market's ups and downs without letting those feelings dictate your decisions.
So it's about learning the ropes and getting comfortable with your own emotional responses without the added pressure of a huge financial risk.
Smart. Exactly. And then as you gain experience and confidence, you can gradually increase your investment.
Okay, so we're preparing like pros, we're managing those emotional waves. What's the next step in this trading journey? Zur highlights something that's often overlooked, keeping a trading journal.
It might not sound glamorous, but trust me, a trading journal can be your secret weapon.
Okay, I'm listening.
It's like having a personal trading coach in your back pocket. You can go back and analyze every trade you've made, see why you made those decisions, what the outcome was, the emotions you were feeling at the time.
So it's like a backstage pass to your own trading journey.
Exactly. And you'd be surprised how many successful traders swear by their journals. They understand that continuous learning is crucial for staying ahead of the game.
Okay, so journaling isn't just for beginners, it's for anyone who's serious about improving their trading game. What kind of things should we be tracking in these journals?
Think of it this way. Every trade tells a story. What was the setup? What indicators were you using? What was your entry and exit plan? How did you manage your risk? And don't forget to capture those emotions. Are you feeling confident, fearful, greedy? Write it all down.
So it's not just about the technical details, it's about understanding the psychology behind those decisions. I'm starting to see how all these pieces fit together: preparation, emotional control, documentation.
Yeah.
It's like building a solid foundation for trading success.
Exactly. Each element supports the others.
Okay, so what's next on Zer's list of common trading mistakes? What other pitfalls can we avoid?
This one's all about expectations, and I think it's something we can all relate to. It's easy to get caught up in those get-rich-quick stories we see online, fantasizing about making a fortune overnight.
Oh, yeah, I've definitely fallen into that trap before.
But the reality is, trading is more like a marathon than a sprint. And if we go in with those unrealistic profit expectations, well, we're setting ourselves up for disappointment and potentially some risky moves.
It's like going on a hike expecting to reach the summit in an hour when it's actually a full day trek. You're going to burn out, get discouraged, and maybe even make some reckless decisions out of desperation.
Exactly. Zer talks about this concept of market neutrality, which is basically about accepting that the market is inherently unpredictable. We can't control outcomes.
So it's about letting go of those rigid expectations and being flexible, adaptable, responsive to the market's ever-changing landscape.
You got it. It's about being comfortable with uncertainty and focusing on making those well-informed decisions based on your research and your plan, not on wishful thinking.
This is great stuff. We're prepping, we're managing our emotions, we're keeping those expectations in check. What's next on Zer's list of trading pitfalls to avoid?
This next one might surprise you. It's about
Okay.
technology, or actually maybe more like our relationship with technology when it
Mm.
comes to trading. I mean, we've got all these sophisticated algorithms, trading software, promising to do all the heavy lifting.
Right, but Zer's saying we shouldn't just blindly follow the bots.
Yeah, exactly. I
Hmm.
mean, think about it. Technology can be incredibly powerful, right?
Yeah.
It helps us identify patterns, analyze data, execute trades at lightning speed.
Yeah, for sure.
But the thing is, if we don't understand the why behind those signals, we're basically driving a car blindfolded. We might get lucky for a bit, but eventually.
Crash.
Exactly.
So we're not ditching the tech. We're just using it strategically.
Right. That's it. Zero uses this idea of a black box, which is a great way to think about these algorithms that spit out signals without really explaining how they got there.
Mm.
It's so tempting to just trust the system. But what happens when the market does something totally unexpected? Something the algorithm wasn't programmed to handle?
Then we're in trouble.
Yeah, we're left scrambling with no idea what to do.
So it's about being an informed user, not just blindly following the signals.
Exactly. We need to understand the logic behind the algorithm,
Yeah.
the data they're using, their limitations.
It's like you wouldn't take a medication without knowing the side effects, right?
Perfect analogy. These algorithms, they're powerful tools, but they come with their own risks and limitations. We have to educate ourselves and use them wisely.
All right, listeners, ready to step into a slightly more advanced trading strategy? Zer's next point is all about the art of short selling. Now, I know this can seem a little mysterious, even intimidating for new traders.
Yeah, it definitely gets a bad rap sometimes. People think it's super risky or even unethical. But Zur really breaks down those misconceptions and explains that short selling is simply a way to profit from a decline in a security's price.
Okay, so demystify this for us. How does short selling actually work?
Sure. So imagine you believe a certain stock is way overvalued and it's likely to go down.
Okay.
With short selling, you're basically borrowing shares of that stock from a broker. You sell them at the current market price and then hope to buy them back later at a lower price.
To return to the lender.
Right. And the profit you make comes from that difference between your selling price and your buying price.
So it's like betting on the stock to go down instead of up.
Exactly. And it can be a really smart strategy, especially in a bear market when prices are generally declining. But like any trading strategy, it comes with risks.
Of course.
If the stock price goes up instead of down, well, then you're going to incur losses.
No, not for the faint of heart.
Right. It takes careful analysis, a solid understanding of market dynamics, a good risk management plan.
Okay, so we've talked about preparation, emotional control, documentation, expectations technology, even short selling. We're covering a lot of ground here. What's next on Zer's list?
This one I think will resonate with anyone who's ever looked at the financial market and just felt overwhelmed by the sheer number of options. I mean, you've got stocks, bonds, options, futures, currencies, commodities. It's a lot.
It really is. It's like walking into a giant candy store wanting to try every single flavor.
Exactly. And it's tempting to want to do it all right, to chase every hot tip or trend.
Oh, yeah, I've been there.
But just like overloading on sugar can lead to a crash, trying to master too many trading strategies or markets at once can lead to confusion, scattered focus, and ultimately poor results.
So what's the solution? What's the antidote to this too much of a good thing problem?
Focus Sir is a huge advocate for specialization. He says, choose one specific market or trading strategy and become an expert in that area before venturing into others.
So resist the urge to be a jack of all trades and instead become a master of one.
That's the idea. It's about developing a really deep understanding of the nuances of a particular market, honing your skills, building a track record of success before branching out.
Makes sense. It's like becoming a world-class chef. You wouldn't expect to master French cuisine, Italian cooking, and molecular gastronomy all at the same time, right?
Great analogy. You'd probably pick one specialty and really pour your passion and energy into perfecting those skills.
Right. So in trading, we're finding our niche and becoming an expert.
Exactly. Specialization allows you to develop what's called a comparative advantage, a unique set of skills and expertise that really sets you apart in the crowded world of trading.
Okay, so we're specializing, we're laser focused. Now, how do we know when to actually make a move? That brings us to Zur's next point, which is all about timing.
Ah, yes, timing. That elusive element that can make or break a trade. It's something even experienced traders can struggle with. Zur points out how new traders often jump into trades too impulsively or they hesitate for too long, so they either miss out on opportunities or get caught in unfavorable positions.
Oh man, I've totally been there. I remember this one time I was watching a stock climb steadily, but I kept waiting for a pullback, a chance to buy in at a lower price. Well, that pullback never came, and the stock just kept going up. I missed out on a huge gain because I was too focused on getting the perfect entry.
It's a classic mistake.
Yeah.
And on the flip side, I'm sure we've all experienced that fear-driven impulse to sell at the first sign of a dip, only to watch the stock rebound almost immediately.
Ugh, yes. The dreaded panic sell. So how do we get better at this whole timing thing? How do we know when to act and when to wait?
Well, Zura recommends a few approaches. One is technical analysis, which is basically studying price charts and using those indicators to identify patterns and trends. Things that can signal potential buying or selling opportunities.
Yeah.
For example, you might look for breakouts above resistance levels or support levels to confirm a bullish or bearish trend.
So it's like learning to read the language of the charts, those visual cues that can help us anticipate those market movements.
Exactly. Yeah. But it's not just about the charts. It's also important to consider fundamental analysis, which involves evaluating a company's financial health. Their earnings reports, their management team, their position in the industry.
So we're combining those technical signals with a real understanding of the underlying business or asset. We're like detectives gathering clues from both the charts and the real world.
I like that. And it's important to remember that timing is not an exact science. It's about developing a feel for the market, understanding the forces at play, making calculated decisions based on your research and your risk tolerance.
Okay, so we're specializing. We're honing that sense of timing. What's next on our list of strategies for avoiding those common trading mistakes?
Let's talk about something that's often misunderstood, but so crucial: setting proper stop losses.
Stop losses. They're our safety net, right? The point where we say, okay, I'm willing to cut my losses and get out of this trade if it's not going my way.
Exactly, but this is where a lot of traders make a mistake.
Yeah.
They set stop losses based on random percentages, or even worse, based on their emotional tolerance for loss.
So it's not just about saying, okay, I'm comfortable losing 5% on this trade and setting the stop loss there.
No, Zur's point is that stop losses should be determined by the market itself, not by our feelings. He suggests analyzing support and resistance levels.
Yeah.
Those price points where a stock has historically struggled to break through.
So we're looking at the past behavior of the stock and using those patterns to decide where to place our stop loss.
Right. For example, if a stock has consistently found support around $50, you might set your stop loss just below that level, maybe at $49.50. That gives the trade some room to breathe while still protecting you from a major breakdown.
It's about finding that balance between giving the trade space to work and limiting those potential losses.
Exactly. And remember, stop losses should be dynamic. You adjust them as the trade progresses and new support and resistance levels emerge.
Okay, that makes sense. So we're prepping, we're controlling our emotions, we're setting realistic expectations, we're using technology wisely, we're embracing short selling, we're specializing, we're mastering timing, and we're setting those stop losses strategically. What's the final piece of the puzzle?
This one's all about understanding and calculating risk-reward ratios.
Risk-reward ratios. This sounds important, but also a bit intimidating. Can you break it down for us?
Absolutely. The risk-reward ratio basically measures how much potential profit you stand to gain compared to the potential loss you're willing to accept on a particular trade.
So it's not just about whether a stock is likely to go up or down. It's about the magnitude of that potential move.
Exactly. Let's say you buy a stock at $100 and you set your profit target at $110. That means your potential profit is $10. Now let's say you set your stop loss at $95. So your potential loss is $5.
Okay, I'm following. So how do we get to the risk-reward ratio from there?
It's simple. You divide the potential profit, the $10, by the potential loss, the $5. That gives you a risk-reward ratio of 2.1, meaning for every dollar you risk on this trade, you have the potential to gain $2.
Wow. Okay, I see how this is powerful. So the higher the ratio, the better.
Generally, yes. Zillow recommends aiming for trades with a risk-reward ratio of at least 1.1, meaning the potential profit is equal to or greater than the potential loss.
So it's not just about winning trades, it's about making sure those wins are big enough to offset those inevitable losses that are part of trading. It's about maximizing gains and minimizing risk.
You got it. And this is where all those other principles we've discussed come into play. Preparation helps us identify trades with good risk-reward profiles. Emotional control keeps us from chasing those high-risk, high-reward gambles. Stop losses help us limit our downside.
Wow, we've covered so much today. From the importance of preparation to the details of risk-reward ratios, Zer's given us a real roadmap for navigating the complexities of the market.
And, it's amazing how these seemingly separate concepts are all actually interconnected. It's like weaving a tapestry. Each thread contributes to the strength and beauty of the final piece.
I love that analogy. And what I find so valuable about Zer's approach is that he doesn't just give us the technical tips. He encourages us to really become students of ourselves, to understand how our emotions and biases can impact our trading decisions.
Absolutely. He's reminding us that trading isn't just about mastering indicators and crunching numbers. It's about self-awareness, discipline, and approaching the market with a balanced perspective.
So as we move into the final part of our deep dive, I want to encourage all of you listening to think about what's resonating most with you. Which of these common trading mistakes have you maybe made in the past? Which strategies we've talked about feel most helpful for you to try in your own trading journey? Let's take a quick break to gather our thoughts, and we'll be right back to explore those takeaways and how you can use these insights to trade with more confidence and skill. All right, we're back. So much good stuff to unpack from Yul Zer, all those insights about avoiding common trading mistakes.
Yeah, and what really stands out for me is that emphasis on self-awareness. It's not just about following a set of rules. It's about becoming more aware of our own minds, understanding how those emotions and biases can really trip us up in the market.
Oh, totally. It's so easy to get caught up in the excitement, the fear, the greed, but Zer's like, hey, slow down. Pay attention to what's going on inside your head.
Yeah, the market's going to do its thing. It's unpredictable. We can't control that.
Right.
But we can control how we react.
And that's what's so empowering, right? Like, this actually goes way beyond trading.
Absolutely.
It's about making decisions under pressure. Whether it's a big career move or a financial investment or even just dealing with those everyday challenges, knowing how to stay grounded when those emotions are running high, that's a game changer.
Couldn't agree more. It's about building that resilience.
So as we wrap up our deep dive into Zer's wisdom, I want to leave you with a challenge. Think about your own trading journey, or maybe even just your approach to decision-making in general. What are some of those patterns or habits that might be holding you back?
And remember, there's no shame in admitting those mistakes. It's actually the first step to growth. It's about saying, okay, I see this pattern. Now what can I do differently?
Exactly. And as you're thinking about those patterns, think back to the strategies and techniques we've talked about today. Which ones resonate with you? Which ones feel like, aha, I need to try that?
The key is to experiment. Start small. See what works for you. There's no one-size-fits-all approach. It's about creating a trading style, a decision-making style that really aligns with who you are and what you're trying to achieve.
I love that trading is a journey, not a destination. It's all about learning, adapting, refining your approach.
Absolutely. Embrace those challenges. Learn from your mistakes. Never stop seeking knowledge.
Couldn't have said it better myself. So glad you joined us on this deep dive into the world of trading. Hopefully you're feeling a little more confident and prepared to navigate those market waters.
And remember, it's not just about the technical stuff. It's about understanding yourself, your emotions, your biases. That's what can really make the difference.
That's where the real magic happens. Thanks for listening, everyone.